Assalamu alaikum. My name is Taha, and today I will talk about incremental analysis. We have one objective, is conduct incremental analysis to decide whether to keep or drop the product to maximize operating income. Okay, we have function here. You have to know what to solve the mathematical questions. Okay, contribution margin equal selling price minus variable cost. Now fixed cost equal fixed cost per unit time unit sold. Sales revenue equal unit sold or unit price times unit sold. Variable cost equal variable cost per unit times unit sold. Lastly, net income equal contribution margin minus fixed cost. Okay, while a company operates a small factory in which it manufactures two products, C and D, production and sales result for last year were as following. This is production sales for last year. Okay, but now we have new products as E here. First schedule is from the questions, except the contribution margin. Selling price per unit, it's here 118 or 80 for D. Variable cost per unit equal 55 in the C, and for D it's 45. E, the selling price from the question is 120, and variable cost is 45. And computation margin, we have to subtract the selling price from the variable cost. It's equal 75. Here it's equal 25. And in the C equal 45. Okay, fixed cost, as we said before, fixed cost equal fixed cost per unit times unit sold. So we have to multiply the fixed cost per unit times unit sold. 27 times 20,000 equals 540,000. And here same calculation, and total will be 1,375,000. Okay, now we have to compare C and D. Unit sold from the question is 20,000 and D 31. Okay, sales revenue, as we talked before, sales revenue equals unit price times unit sold. So unit price here by 100 times unit sold 20,000 equals 2 million. Here same calculation, 80 times 31,000 equals 2,480,000. Okay, here we have to list the variable cost. Variable cost equals 55 times 20,000, as we said before, and here same thing, 45 times 31 equals 1,395,000. Okay, contribution margin, as we know, we have to subtract the sales revenue, okay, or sales price to variable cost equals 900,000. Here equals 1,085,000. The total for each one, like this way, okay. Fixed cost from the question is 1,375,000. Okay. Subtract the contribution margin from the fixed cost to get net income. As we said before, contribution margin subtract or minus fixed cost. Okay, the net income for C and D equals 608,000. Okay. Now we have to compare profit C and D. Company profit to the product C and D. Units sold is not 20 because it's increased by 10%. So we have this calculation, 20,000 times 0.10 to get 22,000. And for E, it's from the question, 21 units of E. Okay. Sales revenue, as we doing before, we have to multiply the unit sales times unit sold. Okay, we will get 2,200,000. For E, same thing. Okay. Variable cost for C, we have to multiply the 55 to 22, new price, 22,000. And for E, same thing. It's 45 multiplied by 21,000 to get 945,000. Okay, total like this way, 2,200,000 plus 2,520,000. Here, same thing. Now, the net income equals, as we said before, contribution margin minus fixed cost. Contribution margin, it's 2,562,000 minus fixed cost from the question, 1,377,000 equals 1,188,000. Okay, the increased by 518,000. So this question says, should Twyla company introduce product E next year? Explain why or why not. Show the calculation supporting your decision. Okay, we have to, we already calculated this numbers, and increased by 580,000. So yes, they should introduce product E, since net profit would increase by 580,000.